a long history with credit unions, and ironically, just got an email from Actors Federal in New York City that yesterday was my 26th anniversary with them as a member. I also did all of their mortgages for many years prior to joining Inclusiv, as well as many other CUs in the New York City area. So I do have a long history with the credit union movement. Before we continue, I'd like to ask that you leave your cameras on so we can see you during the session, if that's possible. Also, a quick reminder that this session is being recorded and it will be made available with all the conference material by October 11th. That's going to be on Inclusiv's YouTube channel, and that is Inclusiv CU Networks. We'll be putting that up in the chat box so you have that. Our colleague Elsa Sima will be monitoring the chat box, so please put your comments and questions there throughout the session. We'll try to get to as many as we can. At this time, I'd like to introduce my co-host for this session, Inclusiv's Director of Lending Development, and my friend, Mr. Ahmed Campbell.
Thanks, Bob. Yeah, that's the good old space bar. But thanks so much, Bob. And a very warm welcome to our panelists and everyone in our audience today. As Bob mentioned, I am Director of Lending Development, and it's very nice to see all of you. And I hope that you had a great summer. Yes, summer is over. That's where it ends. But we'll still be friends. Ideally, it would be great if I could meet everyone in the audience today one-on-one, but there are only so many hours in a week.
Come on, Ahmed. What's a few more hours? What are you doing? Only about 70 plus per week?
Yeah, give or take 140. But I'm sure that I'm not alone in this wonderful world of pandemic season.
Exactly.
But just to get us started, I really just wanted to share with you, set the expectation for today by just sharing with you our agenda. Welcome remarks. You hear Bob and I, yes, that is just who we are. But just a quick introduction to Inclusiv Mortgage. We're going to cover servicing. We will bring in our partners from CUMA, the Credit Union Mortgage Association of America, as well as discuss PMI with Arch. And then we're going to be turning to our main topic, which is turning declinations into approvals. And then we will allow time for some audience Q&A because we'd love to hear from you. As Bob pointed out, Elsa will be monitoring the chat box. So as you have questions, certainly feel free to go ahead and put those in. Again, we want to hear from you. This is your conference. So we're just really looking forward to hearing back from you today.
Definitely, if you have questions throughout, just put them in there whenever you think of them. We'll just have a little bit of time at the end for additional questions. So thanks, Ahmed. Before we get started, I'd like to introduce our panelists today. First, we are happy to have with us Vanessa O'Bannon. She is the Associate VP of Mortgage Loan Servicing for CUMA, and that's again stands for Credit Union Mortgage Association. They have been a fantastic partner with us for many years now. So Vanessa, why don't you say a few words to our audience? You're on mute.
Okay, good morning, everyone. My name is Vanessa O'Bannon. I've been with Credit Union Mortgage Association for 18 years. I run the servicing department there, which generally we just do general servicing, posting payments, loss mitigation, collections. So it's a pleasure to be here this morning.
Great to have you with us, Vanessa. Yeah, we work very closely together.
Yes, we do.
Servicing is a big part of this, yeah. We also have with us from Arch, our mortgage insurance partner. And again, we've been partnering with Arch for many years. It's been a fantastic partnership as well. So I want to introduce Ira Oskowsky, who is the VP of Sales for the Eastern region. Ira, go ahead and say hello to the audience.
Hello, all. Bob, thank you for having me. Ahmed, thank you. We really appreciate being here today. Many of you know me from CMGMI days. CMGMI was the predecessor to Arch, and we've been working with the National Federation and now, obviously, Inclusiv for probably about 7 years now. So we're here, and as I said, I'm really, really proud to be on this call today with so many credit unions. One thing I do want to point out, I strictly work with credit unions nationally. I don't work with the bad side, the bank side. And I'm really, really appreciate when I hear mortgage professionals within the credit unions get together and talk about, their experience with providing loans to their members. So glad to be here, Bob, and thank you very much for having me.
Great. Happy to have you with us today, Ira. Last but certainly not least, we're happy to have with us Paul Catalano. Paul is the Director of Mortgage Lending for OnPath Federal Credit Union in Louisiana, of all places. We know what's been happening there, Paul. So why don't you say hi to the audience and give us a little update. I think I was watching PBS last night, and I know it's gotten better for a lot of you, but it looks like quite a few people were, their homes were like completely destroyed and they had no insurance, and it looked pretty grim. So we're glad that you're with us today, and we're glad that you are on the rebound.
No, appreciate it. Yeah, Hurricane Ida came through a couple weeks ago, and it hit us pretty hard. Some of our parishes or counties, depending if you know the difference, were very, from utility poles, basic things like water and power and internet are still, 30 days out before we get anything. Luckily, at OnPath, we were actually never shut down. We had a team that went out off-site, made sure our call center was up. We were up for our members. From the mortgage department, of course, all the units that we have or properties that we have, we've been here for the members, trying to deal with insurances, the adjusters coming out. Of course, FEMA is now involved, SBA is involved. So we're doing what we can. So we've been through two real big ones. We had Katrina several years ago, which is kind of the anniversary of Ida, and then this one. So back in the day when Katrina hit, we were actually ASI, and we rebranded to OnPath. So still been here for 60 plus years. But yeah, we are on the mend and hopefully be back to normal in a few months.
Fantastic. Okay, so for those of you with us today who already know how Inclusiv Mortgage works, just please bear with us. For those of you who are new to Inclusiv Mortgage, we will do a brief overview of what we offer and how the process works. Then we'll move on to the topic of the session again, how to turn declinations into approvals. So before we get into how Inclusiv works, Ahmed, any thoughts on what's happening on the mortgage front, especially in regards to the low to moderate income communities, people of color?
Bob, so many things, and thanks, Paul, just for sharing your experience and just also the credit union's commitment to really being there for your members when they need you most. The boots on the ground, we can't say enough. And again, not only our thoughts and prayers are with you, but also whatever resources that we're able to assemble to help you and continuing to forward that assistance to your membership. But a great question, Bob. I read, I'm constantly reading, but according to bankrate.com, although interest rates have inched up recently, they keep coming back down, and they remain at historic lows, spurring demand in both home purchases and mortgage refinancing. However, many lenders have tightened up their borrowing standards due to the economic uncertainty of the pandemic. And hopeful loan applicants may find it hard to get approved. According to loan level data, coming from out of the Home Mortgage Disclosure Act, what we know as HMDA, the denial rate for conventional single family loans was 18.8%. And that excludes withdrawn and incomplete applications in 2019.
18.8%. That's 19%. That's a huge percentage. That's a fifth of everything out there. Do you know what that translates into numbers?
Come on, I'm a numbers guy. Great question. That's almost 400,000 applications, Bob.
400,000, geez. So if we could just save 1% of that, that would be 4,000 loans, and that would be a lot of new homeowners. As you'll see later in this, as we get into how to turn these around, those numbers are could increase drastically. So I want to see where our audience is at. So let's start with a poll question. You want to run that?
Yeah, absolutely, Bob. Yeah, here's our first questions. So what percentage of your loans are currently declined through some form of automation? And if you could just take this time right now just to complete this poll, we appreciate it.
Just question number one for the time
Yep.
being. Be curious to see where everybody fits in the national average. Take a look and see who we have on this call today.
Yep, and our responses are almost about 50% completed here. Again, don't be shy here. This is anonymous, and your responses will only be shared with, just kidding, completely anonymous, but definitely want to hear from you.
Yeah, we won't be putting the spotlight on anybody.
Bob promises I don't.
Okay, I'm looking at the chat box. It says not everyone may be able to respond. So what do we have so far? Do we have
Yeah, just taking a look right now, up to 10%. We have 67%, more than a third. I'm sorry, I actually more than almost 70%. 10% of their loans are declined through some form of automation. So right out of the gate, those loans are turned down. And as we can see, just looking at the responses that are coming back through, this is a substantial percentage if you apply these percentages to the actual volume of applications coming through. So clearly, there is, as we would say, Houston, there is a problem. And this is what we hope to address in this conversation today. Let's go to the next question, Bob.
Yeah. Do you have a plan in place to turn declinations into approvals? So we'd like to see. Oh, there we go. Yeah, I couldn't see that on the first one.
Okay. I'm going to switch over to our next question. And here's our next question here. Do you have a plan in place to turn your declinations into approvals? Some great feedback here that we're seeing. So it looks like we have the majority of the audience that does have a plan in place, although there are some of you who don't have a plan, a formal plan in place that would turn these declinations into approvals.
Can you show the results?
Yep, I'm gonna just wanted to make sure everyone got their responses in and to share the results with you folks.
Okay, well, there's 41% that does not have a plan. So that is good for this session. I'm glad that you're here actually, because we do have a plan that hopefully will help with that. Ahmed, any thoughts about, why there are so many declinations in general?
Well, Bob, it's the we'll call it the same old, and this is not an accusation towards, the credit unions, especially in the mortgage lending space, but we're heavily reliant on the GSEs. So, we're working with the DUs, the LPs, and what are those doing? Those are running, the typicals, the credit score kickouts. Those are going to run the DTI kickouts, et cetera, et cetera. And time is of the essence. You're up against the Amazon experience each time that you're engaging, with a mortgage applicant. So thinking that you can take, the days and the weeks, and I go back, to, old days back when mortgages were completely on paper. There were no DUs and LPs, and you take 3 weeks to make a decision. And now they want that information right away. So this is what credit unions have to balance that service aspect out of getting a quick decision back, but also getting a quality decision back that's going to be something that they can put into the secondary market.
Great. Traditionally lenders have their standards and they have their standards. And if you as a borrower don't fit into those standards, and you don't get the loan. We're really trying to flip that whole thing around and really look at the communities we're trying to serve, see where they're at, and develop standards based on their needs. And that's how we work towards our mission of trying to get as many low to moderate income people and people of color into their own homes. I would love to know the audience's thoughts about this. So, do comment in the chat box. We'll look more into this issue in a bit, but for now, I'm going to turn it back over to Ahmed, and go ahead and I know you just put that thing up, the reasons why mortgages are declined. If you want to speak to that for a second.
Yeah, absolutely, Bob. Again, going right into the facts. Check the statistics. The two most common reasons mortgage applications are denied are debt to income ratio, which represented more than 37%, and adverse credit history at 35% of all denials. Mortgage application denial rates, they also vary by the race and ethnicity of the applicant. Non-Hispanic, white applicants and co-applicants of different races, and joint applications had the lowest denial rates at 17%. Black American, Indian, or Alaska Native, and applicants of two or more minority races all had a denial rate that was more than twice as high as that for white applicants. Hispanic or Latino borrowers also had high denial rates at nearly 30%. The difference in denial rates, it reflects differences in credit profiles and application types across different demographic groups, but it also may reflect racial and ethnic discrimination in lending behavior. But this is where Inclusiv Mortgage can help credit unions make a difference.
Exactly. So why don't we go on and start to tell, for those people who aren't familiar with how Inclusiv Mortgage works, exactly what we do. I'll let you start with that, Ahmed.
Sure, Bob. Be happy to share this with you. Inclusiv offers two programs. First, the bulk program, where we buy blocks of loans seasoned at least 12 months from credit unions who need to free up capital or reduce rate risk. Credit can go down to 550 and DTIs up to 50%. We will buy seasoned loans that are under 12 months with temporary recourse that falls off once the loan reaches 12 months. Bob, why don't you share a little bit more about the Flow program?
Absolutely. Okay, so our second program is called the Flow program, and this is where you, the credit union, originate, process, underwrite, and close a loan to Inclusiv guidelines. You do it in your house using the exact same process you've always used. You just do it to our guidelines. After you close, you submit a loan package for review by us, and then we schedule the funding, which typically happens in under 2 weeks of your closing. So I'll just give you a broad overview of some of the guidelines. I don't want to spend a lot of time on this because I know some of you in this session have already seen this. So for those of you who haven't, in the Flow program, we do have the two loans. One is a 30-year fixed for US citizens with a social security number, and we have a 10-1 ARM for non-US citizens with an ITIN number. The 30-year goes up to 97% LTV. That's with mortgage insurance, and the ITIN goes up to 80%. Obviously, we don't need mortgage insurance for that. Both loans go down to 620 credit score and up to 45% DTI. So that's a very broad overview, but in the interest of time, certainly if you'd like the full guidelines, we're happy to get them to you. Also, we'll tell you in the chat box the email to send a request for more information. So while we're on this topic, since I mentioned mortgage insurance, it's a good time to bring Ira in to talk about mortgage insurance, because the rates we get from you guys, Ira, are fantastic, 6 to 18%. So why don't you tell us a bit about how Arch works and how you keep premiums so low for us. It's fantastic.
Sure. Thank you, Bob. In preparing for this, Bob and I spoke, and I said, should I go over mortgage insurance? And he goes, please don't. Please don't get involved in explaining mortgage insurance. First of all, everybody understands mortgage insurance, so I'm not going to do that. But by the very nature of mortgage insurance helps people afford homes. Frankly, I think mortgage insurance has a bad rap over the years. So why do I have to go ahead and, as a financial institution, why do I have to require mortgage insurance? But it allows people with low down payment capability to actually afford that mortgage. One of the things that I want to say, and we have, again, a very close relationship with Inclusiv over the years, is we know that they are really, truly communicating with the credit unions exactly what the credit unions need to do in order to move forward on not only mortgage insurance, but providing their members with quality loans, even those members that maybe could not normally afford to be in homes. So they do a very, very good job, and that's why we're able to offer some very, very low rates. One of the things that I want to point out, and I think it's really important to point out, is we're very, very, very flexible. So is Inclusiv. If there's something that you really truly believe in for your member, if there's something that is kind of slightly off, you know, clearly we will try to find offsetting reasons to kind of do transactions that won't normally be done. So with MI, we have two separate products, AMI and AMGC. Let me explain that really quick. AMI is our standard program. We follow rules that are set forth by Fannie and Freddie, and Fannie and Freddie will buy those loans once they're approved. Where we're working very closely with Inclusiv is another business section that we have, which is AMGC. It's Arch Mortgage Guarantee Corporation. It's a separate mortgage insurance company. It is not approved by Fannie and Freddie. They are not involved in the guidelines for that. It's strictly what we individually are willing to go ahead and do as an organization. We actually fund AMGC. It's not saleable in the secondary market because Fannie and Freddie are not interested in buying those loans at the time those loans are done. But what it does allow you to do is for portfolio lending, if you want to do something, it's definitely outside the box. It's for loans that maybe you would not normally do, but you really feel it's important to do. We will go ahead and kind of be more aggressive with the guidelines than we currently would be on the AMI side. As I said, AMI is very, very restricted in a lot of ways because Fannie and Freddie, even though we don't follow them directly, they require certain things that we can't always provide. So we formed this other entity, AMGC, that works very, very well with many of the loans that you have available for your membership and what's in the Inclusiv portfolio of products.
Yeah, that's where I would say probably the majority of our loans are on the AMGC side, the portfolio side. How does it work? What's the process like for getting set up with you guys?
Right. It's actually very easy. And Bob has sent us various credit unions that have been interested in doing business with us. One of the things I would suggest all of you do is automatically, let Bob know. Bob will reach out to us, or you can call me directly, or you can call your account manager in the area. Definitely get signed up with a master policy. We will sign you up for a master policy on the AMI side and the AMGC side. It's an easy process. It's really just our master policy. You may want to have it reviewed by your in-house attorney, but if not, it's, as I said, standard language, and it's very, very easy to sign up. So again, please reach out to me. I'll give you my number. If anybody that wants to write it down, it's 973-303-3524. Or if you can go to our site, archmicu.com, you can see who the account managers are for your particular area, and they can also help you and walk you through that process. But Bob has been communicating where one of the Inclusiv credit unions, or credit unions that work with Inclusiv, he's been communicating to us, and we've been automatically sending out our account managers to work with you directly in getting a master policy.
And like you said, it's an easy process, and I believe it's only literally 2 pages that you fill out, and then you submit it for for approval.
Correct. It's actually a very, very easy process. And one of the things that I also will say, Bob, is every credit union should go ahead and sign up. If you never used us, if you never work with Inclusiv to kind of use us for some of the programs, it doesn't hurt to sign up and make it available, because at any point a loan may come in from one of your members and they really need mortgage insurance on it. And if you don't have the master policy, you can't get mortgage insurance. So sign up and get it squared away, both on the AMI side and the AMGC side. And it would be perfect. It's available to you if you need it.
Yeah, I mean,
Thanks,
talking
Bob.
about turning declinations into approvals, for people that are really on that line with DTI, if you're looking at a company that's going to offer you 30% and you're offering 12 to 18%, that could make the difference between a declination and an approval right there. So,
yeah, there's no doubt about that. I mean, again, I view mortgage insurance, and I work for CUSO. I work for the State Housing Agency in New Jersey. There's nothing like mortgage insurance to make a product available to those members that need it. So we are one step in making it closer for affordable housing, and we're one step in making a mortgage possible for many of your members.
fantastic. Okay, so at this point, let's bring Vanessa into the conversation to talk about servicing, because servicing is a huge part of this whole process. And I don't know if you can see it, Vanessa, but we put a little thing on the screen there, so you can address the different types of servicing that's available.
Sure, Bob, thank you. A little bit about Credit Union Mortgage Association. We were formed in 1978 as the nation's first CUSO, which is the Credit Union Service Organization. We're 100% owned by credit unions. We exclusively serve the credit union community, and we're headquartered about 20 miles outside of downtown Washington, D.C. in Fairfax, Virginia. And currently, we are servicing about $2 billion in loans, and we originate about $1 billion each year. We've been partners with Inclusiv for about 5 years now, and our relationship with them is to provide loan servicing for credit unions that do not retain servicing. These credit unions originate, process, underwrite, and close their mortgages, then sell them to Inclusiv, and then we take over for servicing, like collecting payments, handling the escrows, which is real estate taxes, homeowners insurance, PMI, and loss mitigation if necessary. We handle all of the monthly reporting and the remittance to Inclusiv each month. We also master service for the larger credit unions that do retain servicing, which means the credit union is actually servicing the loan, but remits the payments to us at the sort of central collection point. And then we submit one master monthly report and remittance to Inclusiv. We are just now beginning to also offer processing and underwriting services for Inclusiv credit union partners who want to outsource that function as well. But these credit unions handle all the aspects of originations, but we are working on a model where we will assist with the originations, but we're not quite there yet.
All right, so just to clarify, so if a credit union signs up to sell to us and they want to continue to service on their own, well, first of all, I'll just say that if you're already Fannie, Freddie, or if FHLB approved to service, then it's a very quick, easy, streamlined process for you guys to continue servicing with us. If not, then you do have to go through the approval process to become a servicer of those loans. And then in that case, then you become a sub-servicer and you communicate with CUMA as the master servicer. Correct, Vanessa?
That is correct, Bob.
Yeah. And then for credit unions that are happy to give the servicing up, CUMA becomes the servicer.
Yes, that is correct.
Okay, so all of the reporting, all the remittances, no matter what, go through you, and then you give us the monthly reporting.
That is correct.
Great. Okay, and if anybody has any questions, we're just looking through the chat real quick. Looks like we're okay. Please put your questions in the box if you have any questions so far. All right, let's continue on. We'll be talking more as we go along. At this point, I'd like to bring Paul Catalano into the conversation to talk from the point of view of a credit union who's been actually using Inclusiv as a secondary market outlet. Paul, you want to maybe start by talking about your experience with working with Inclusiv? Only good things.
Only good thing. That's what we.
Otherwise, I have to hit the reject button.
You know, I came to OnPath to help grow and expand the mortgage department. They had slightly used Inclusiv in the past. A lot of stuff was done in-house, and then no real investor relations. So when I came on board, I started to reach out, talk to Bob, kind of figured out exactly what Inclusiv did. So from an initially standpoint, we just viewed Inclusiv as just another partner. And then as Bob and I started working together more, we found about the whole turning declines into approvals. And we do two things over here. We do about 60 applications a month. The average application is roughly about 255,000. And we approve most of those, I'd say 60-ish% as is. We'll take about 10% of those, about 10 of those deals, so roughly about 20% of those we will approve, but it's a condition. We're countering in some way, shape, or form. And then the other ones, of course, we were just declining. So after, Bob and I started working together, one of the things that we started to do is we got Inclusiv's guidelines. And right off the bat, it was astronomical to see what we could do from a partner standpoint, because one, we're helping the member out, which is the mission of all credit unions. Two, it doesn't hurt that, we get to sell the loan to Inclusiv, the deal gets done, and then of course there's the compensation involved. So we started to get these deals that we would start to potentially pass on based off of our overlays. We've now partnered with Bob and Inclusiv. I deal with Bob with Inclusiv, and it is a fairly streamlined process. Our underwriters know what we're looking for. The underwriters know what Inclusiv is looking for. We have a sheet that we fill out. We send it to Bob. He looks at it, and then he kicks back what his requirements are. It has been, since we started, I think we've got 7 deals. I was looking at my numbers correctly. And of course we had the hurricane that hit. So that took, again, about 3 weeks that we just lost completely. But since we really started ramping this up, I mean, it's been an eye-opener process of why. Look at the opportunities that we have left on the table or on the floor, if you want to put it that way, just based off of we're helping the member out, we're making a little bit of money on the back end, everybody's happy, and it's actually in a very, very, very easy process. You get their overlays, you end up underwriting to them, the member gets the approval. Some of y'all are keeping your stuff portfolio based. Some of y'all are selling to investors anyway. So this is just another partner. And then, Bob's communication has just been, hey, here we are. We'll work with you. They talk to the MLOs. They talk to the processors. Everything is very transparent. There's no hidden agendas, no hidden fees, no nothing. So I'm more than happy to advocate for Inclusiv, because we have been using them and have been booking loans and have been selling loans, and couldn't be happier with the process. I'm not just saying that because this is an Inclusiv call. This is it's benefiting everyone across the board.
It's funny because I feel like some of your staff is actually my staff, because Ashley and I talk probably 3 or 4 times a week, sometimes daily. And the whole point of this is we're not going to save all declinations, obviously. And we'll show you the process that we're offering to kind of at least have a plan for these declinations. But certainly, there's obvious things that we're not going to do, a proper, a loan for somebody who just foreclosed, who
Correct.
just did a bankruptcy, who has nothing but not one positive thing on their credit report. You know what I'm saying? In those cases, you don't even have to, do the process. We're talking about the ones that are actually could be could be saved if we can just, figure out how to do it.
And the other thing that I would say that is important to me is the communication piece. Again, if you're dealing with investors, sometimes there is no communication. This is where we're at. I see what you're talking about, but sorry. With Bob, at least you can have a conversation and say, hey, this is what's going on. And, that's what, some of our members need Inclusiv, and we can explain that. And if it makes sense, we can move forward. It's not just, oh, you don't fit in our investor box. Sorry, have a good day.
Exactly. Yeah. And again, our mission is to get as many low to moderate income people and people of color into their own homes, and this is a way that we can really, make an impact, because a lot of those communities are in these, in these declination piles.
Yep.
So, all right, before we continue on further with that conversation, I just want to check in with Vanessa. I don't know, we've been hearing stats from everybody, but, CUMA, for those of you who don't know, they offer many services. And one service that they offer is outsourced processing and underwriting for credit unions that want to take advantage of that. Some credit unions don't have the staff, or they simply, want to outsource it for whatever reason. So CUMA is available for you to do that. Which means that they're dealing with declinations as well. Do you have an idea of what the CUMA declinations look like?
Well, Scott is the president and CEO of Credit Union Mortgage Association, and he said we're doing approximately 600 loans per month, and 80 are declining each month. He estimates about 40 of them are ultimately done as portfolio loans, but that leaves 40 loans with the big question mark as to what happens with them.
Right. So there you have it again. 40 loans that potentially, a percentage of those could be saved, and again, just feeding right into the mission to get more people into their own homes. Okay, great. So. Paul, just real quick, prior to working with us, did you guys have any kind of process for trying to get your declinations turned into approvals?
Not really. It was most likely probably what everyone else was doing, which is trying to make the member fit into the existing products that we had. If it was a DTI issue or, something along those lines, maybe, restructure a deal if it made sense, or just lower the dollar amount.
Yeah. And that goes in. Go ahead. I'm sorry.
I was going to say, and then other than that, it was really just talking to the member saying, hey, this is why we can't approve you, kind of walking them through it and explaining it. But if it's a credit score, a DTI, some of those things can be fixed in, a month if it's just pay your credit card down. But some of those things, it's unfortunately, a long-standing thing to where you can't fix it in 30, 60, or 90 days. And it's, you can tell a member that all day long. And it, unfortunately, it's, you can work with them, but if they need something now, or if it's an emergency loan, or they need to buy a house, or whatever the situation is, it doesn't help them out. So no, we were really just, try to fit them into a product, or we had, the high LTV products, which weren't overly attractive. Yeah. We could kind of get it done, but it kind of didn't make sense. And then again, finally looking at Inclusiv going, okay. And then we started looking at the declines and we're like, okay, this is starting to make sense. And then me and you got together and we kind of put a plan on how can we, turn this around to where we're pumping, 5, 6, 7 deals starting out a month just to y'all that, makes sense.
but you reiterated what I said earlier about how lenders have their guidelines, and if you don't fit into them, basically you don't get a loan. And
All
so
right.
we're trying to really look, for example, the ITIN community without traditional credit, if they were just left to the industry, nobody would be getting a loan. And the ITIN lending is a huge thing. And we looked at it and we were like, okay, so we need to figure out how we can come up with a way to qualify their credit without having to fit into the traditional standards, which is where our alt credit standards came from. So yeah, exactly what I mentioned earlier. So good. I'm glad to hear you reiterate that. Ahmed, let's look at what the audience experiences with declinations. This is not a poll, but in the chat box, I'd like to see, of those of you who don't have a plan, in just a few words, what happens to your declinations? Do they just die, or what happens to those? Just want to look through the chat box and see where you guys are at with that.
And while the audience is sharing their experience with declinations, I just so appreciate just hearing Paul's just being authentic about this. This is not necessarily an endorsement, but truthfully, if credit union's mission is about increasing home ownership, then you have to be intentional. It can't be something that's hidden behind or that's stacked within your strategic plan. And it sounds good in an annual report. You have to be intentional about it. And clearly, as Paul is pointing out, taking that extra time, taking that extra measure to see if perhaps the loan fits Inclusiv's guidelines, to be able to, say yes and actually stand behind it. Really, it just furthers your credit union's mission. And really, being that, that beacon of light, in the midst of all this darkness where, if you're saying no, there's going to be someone else that's out there that's going to say yes, but it's going to be at a much higher cost to your member. And you're going to lose that opportunity just to grow and strengthen that relationship. Because we've all seen where once you get the mortgage, it's a member for life. You create all the ancillary relationships as a result of that mortgage. And it is the most stickiest product, probably second to a direct deposit, that your credit union can have. So again, you have that option of selling with servicing released or with retaining servicing, as Paul and Bob shared with you. So clearly, we really want to talk about increasing the credit union's options so that you can say yes, and you can actually do so much more to help close these gaps that have been with us for far, far too long.
And just to reiterate, I mean, we don't have an automatic process. All of our deals get input manually, and then it goes to underwriting. So the underwriters know, hey, we're going to look at this just as another product. And, if it fits with OnPath, great. If it fits with Inclusiv, great. So I saw the value in it going, wait a minute. Again, it services the community. We get, the clients happy, the members happy. I hate to sound cliche, but it's a win-win, So if you have the ability to just make it part of your basic underwriting.
Exactly.
It doesn't cost anything.
Exactly.
So.
Exactly. We only have about 15 minutes left. Let's do the last poll real quick. And then we'll go into our solution that I want to present to you guys today.
But before you go, we have an answer from one of the participants, Stephanie.
Yeah, let's launch the poll, and then I'll while people are polling, I'll go into it. Thanks, Elsa. So, if there was a process available to perform a second review of your declinations, would you take advantage of it? Simple question. While you guys are doing that, Stephanie at Greylock is saying that they offer financial wellness coaching to guide members towards improving their credit, as well as combing through their budget to help improve DTI, which is fantastic. Counseling is a big piece of this puzzle, trying to get these communities into their own properties. But again, that's trying to get them to fit into the guidelines. For some of them, they're gonna, going through this process, they might be able to actually do it now instead of waiting until they actually improved. Yes, overwhelming yes. All right.
It's official. It's official. Yes.
Good,
There
good.
is certainly a need. So yeah, we're going to go right in, Bob.
All right,
Let me actually just stop sharing this and get this up for you.
Yeah, let's get going here. Okay. So we have a simple process that you guys can follow. It's called a declination quick look sheet. And this is the squished down version, but it's a simple form, has a few parameters to put in and a reason for declination. And hopefully that reason is not just credit issues. I would like you to actually explain what those issues are. You simply submit it to us. We take a look at it, maybe ask for more docs, and then we figure out how we can make this work. And I'll tell you right now, I know with OnPath, I think you guys have officially submitted 4, and we have locked a rate on 1, and the second one will be, I'm just waiting on a letter of explanation, but I've already said yes, basically, with the letter of explanation if the borrower wants to. So that's 50% right there off the top.
That's, yeah, awesome. That's just far. I mean, we've got prior months, we have deals closed with y'all too, so absolutely.
Exactly, and those are regular, regular flow. Exactly.
Yep.
So, all right. So a couple of some reasons why loans might be declined: lack of sufficient funds to close a loan, credit issues, no traditional credit, income issues due to the pandemic are coming up more and more now. Can't get MI due to student loans being zeroed since the pandemic as well. That's coming up a lot also. So here's some of the solutions that we have. We now offer DPA grants, which for some people can mean the difference between getting declined and getting approved right there. I'll just give you a few brief parameters. It's a 5-year forgivable grant, amounts up to 1.5% of the purchase price. It maxes at $2,500. Not a big amount at this point, but this may increase down the road, but you can combine this with other sources of DPA you have access to as well. Income must be at or below 80% of AMI, since we're trying to target the LMI population, and LTVs must be at least 90%. So even though it's not a huge amount for a borrower, for example, in a low priced area doing 97% financing, that alone could mean the difference between a denial and an approval. So moving on, we'll look at credit issues. This was an actual one that came through where the mid score was 590. We go down to 620. So obviously going through traditional channels, if a GSE goes down to 620 and you're at 619, you're not going to get that loan. Okay. So we looked at this, and this was due to a couple of small medical collections. Okay. Inclusive discounts medical collections, as though they're not even there. If they're under 250, they don't have to be paid. If there's a bunch of them and the combined total is does not exceed 1,000, then that's a doable loan, even at 590 credit score. Ira, how does Arch handle collect things like medical collections and that kind of stuff?
Sure, Bob. One of the things that we do is we're very flexible. So we'll take a look at individual situations and communicate it to you. One of the things that I just want to point out, I love what Inclusiv is doing here, because if it's something, and I say this to credit unions across the country all the time, if it's something you really truly believe in, and it's right on the fence, and it's something that you really feel should be done, try to take another look. Don't take a declination. Again, as Paul has pointed out, and Vanessa pointed out, and Bob pointed out, there are plenty of things. You're the only ones that they could go to out there. Ahmed mentioned this too. You're the only one. So if something is on the fence, or if something is just declined for various reasons, and you really truly believe in it, go ahead and submit it and take another look. Nobody will mind you taking another look. As far as what we do is we look at each loan individually. So before we put mortgage insurance on, we want to go ahead and hear what issues are out there. If there are too many medical bills, right, we will take a look at that and kind of say, does that affect their ability to go ahead and pay? And we will have conversations. We want to do the loan. And there used to be an old saying, it says, if your mortgage insurer, for us, if your mortgage insurer is willing to do a loan, why wouldn't you be willing to do the loan? In other words, put in your portfolio and have mortgage insurance. I think Inclusiv is doing the same thing. Inclusiv wants to stimulate the credit union industry, and they want to take a look, and they don't want to have declines. Sometimes you do have to decline, as Bob said, but always try to take another look if you believe in it and it's something that is pretty close on the fence. So, Bob, the simple answer is we don't have any really strict rules with this. We will take a look at each loan individually as they're submitted to us, and we may make a decision that those medical bills are not to the level that we have a concern raised. Communicate it, and we will discuss.
Yeah, and we've really on this issue we've mirrored what you guys have in your guidelines. So so I know that we can do that. Yeah. Go ahead and do the next slide, Ahmed. This is looking at no traditional credit. Now, I mentioned earlier we did come up with alt credit standards, particularly for ITIN lenders, because they typically don't have traditional credits, hard to get when you're not a citizen. And but we can use this on the other side of the spectrum as well. If what we require are 3 alt lines, such as utilities, phones, internet bills, 2 of them at least 24 months, 1 at least 12 months, and we want a 24-month rent history. If we can get all those things and it looks good, then you know, we're likely to do that loan. And Arch, I know you guys, and this is an interesting point too, because I went to the AMGC, the portfolio part of Arch, to find alt credit, and it wasn't there. It was on the AMI side, which was a surprise, actually. So,
right. Now, Bob, you could go to AMG, and AMG mimics AMI. It's not usually the other way around. So if it's in AMI guides, we will do that. Now, we unfortunately do not do ITIN loans, but we do non-traditional.
We do non-traditional, and you guys will go up to 95%. And the only difference is we only require 2% of borrowers' own funds. You guys, for no traditional credit, require 3%. So so that borrower has to put down an extra percent out of their own pocket, but can get a loan up to 95% with no traditional credit, which is fantastic. Yeah.
And Bob, I think this actually answers one of the questions that was in the chat from Gloria Escobar. You know, why are we seeing where Latinos have like one of the highest declination rates? And it's often due to having non-traditional credit. So clearly, this is where you know, working with Inclusiv's flexible guidelines, where we look to work with you to develop alternative credit. You know, this is where, and it could possibly be one of those answers. It's not going to solve every problem, but it can be one of those answers to addressing that high declination rate in that particular demographic.
Exactly. Thanks for answering that question, Ahmed. And also, you know, the whole conversation about ITIN lending, we could spend hours on it, but it's very scary for a lot of people. It's on paper, it seems risky. You know, we're giving, you know, we're loaning large amounts of money to people that aren't even citizens, you know, and who knows what's going to happen with them, et cetera, et cetera. There's all this fear around that, but ITIN loans, I can tell you, outperform regular loans hands down. It's a family affair. The entire families are all a part of the success of these loans. And even if somebody was to get deported, you know, the rest of the family is there to keep the loans going. And like I said, they perform fantastically well. So, and the process is really exactly the same. We're just in some cases using alt credit. You have to get different IDs. But other than that, it's the same process, and it really, so for those of you who are you know, want to kind of look at ITIN lending and are, you know, still sitting in a bit of fear to get it started, please take that first step and
Reach out
get
to
going.
us.
You won't
Reach
be,
out to us. Yeah, absolutely.
reach out to us.
us.
Yeah, you will be happy that you did, I promise. So look, we're just about out of time. So, but basically, I mean, the verdict is in. The quick look declination sheet does make a difference, as Paul shared with you guys. Right now, we're at 50% approval rate. You know, it's not always going to be that, but we're doing well, and we just started. Whether you're an approved seller with Inclusiv or a CU who has thought about becoming an approved seller, this is a tool that can help your CU turn a percentage of your declinations into approvals. Again, we can't turn 100% of them, but we can change the percentage that is doable. But in order to know which ones are doable, we have to be able to look at them. So,
and that's Bob, yeah, I think we can all agree that there is much work to be done to reverse the course, you know, of such a high percentage of mortgage applications being turned away. You know, we don't have enough time here, but certainly, Bob, I mean, I just hearing the feedback from the audience and the chat, Ira, you know, hearing Paul and Vanessa with really just putting this all together, but really it sits with you know, the folks who are actually, you know, at the grind every day, you know, trying to make the difference in your credit union members' lives.
Exactly. Just one quick question I want to answer. It's from Angela. VCU, do you have data to support the ITIN performance? I can tell you from every credit union that we've spoken to who's doing ITIN lending, we all have the same story. I can tell you from our portfolio, we have virtually no derogatories with our ITIN lenders. So, you know, it's late and I can't go into it anymore. We can certainly have a further discussion. Just get in touch with us, and Elsa will put that information up. And again, we're out of time, so we want to thank you for joining us today. I want to thank our panelists for joining us and sharing your expertise with us. Really pleasure to have you guys here. Really appreciate your partnership. If you have any additional questions, would like more info, or would like to apply to sell to Inclusiv Mortgage, please email us at mortgage@inclusiv.org. Again, that should be up in the chat box. Don't forget to check out Inclusiv's exhibitor booths during lunch and throughout the day.
Yes, yes.
Please return at 1 p.m. to join us for the exciting finish to the second day of Inclusiv's annual conference. And take care, stay well, and hopefully next time we'll see you in Puerto Rico in the spring. We're planning on being back to Puerto Rico. So fingers crossed on that. Again, thank you to everybody who participated today, and stay well, stay safe.
Bye, everyone.
Thank you. Take care, guys.
Take
Bye.
care, everybody.
Thank you.